Just want to say welcome everybody and thank you very much for joining this afternoon. My name is Daire Burke and I'm the head of Swoop funding here in Canada. Today we're going to be discussing the shipping crisis with Cortney Hayhurst, an international currency and financing specialist from Ebury, Canada. So Cortney, it's certainly not new news that there are significant issues plaguing the global supply chain at the moment, and in particular the shipping industry. We're hoping that today we can get a little bit of expert insight from yourself and also some practical strategies that businesses out there can deploy to mitigate against risks associated with the global supply chain and what that poses for business financing. We'll also conduct a short Q&A at the end of the session. So I'd encourage anybody that's dialed in this afternoon to treat this as an interactive session. Please use the Q&A box that's at the bottom of your screen to post in any questions or comments that you have during the discussion. And without further ado, I think we'll jump right into it. So Cortney, you are very welcome.
Awesome, thanks, Daire. So I appreciate the opportunity to participate in today's webinar. We've had many of our clients sharing their challenges as well as their concerns with the most recent crisis. And we hope that today we can help guide businesses to developing a long-term strategy to protect their cash, increase their working capital, as well as improve their margins. So yeah, I'll just pass back to you, Daire.
Cool. So I suppose let's get into the heart of it and what's really been driving these issues. As we all know, the shipping crisis has caused a big shock right across the entire global supply chain. I'd love to know, Cortney, what you're hearing, and maybe if you can, give us a little bit of an insight as to what's causing this.
Yeah, for sure. So the situation really begins as 80% of global trade is transported via ship. So because of this, reliance impacts to the shipping industry leave a lack of alternatives, which then causes large backlogs. What we're seeing is the pandemic has laid vulnerabilities in the global shipping industry, with the flow of goods seeing a huge traffic bottleneck. In the shipping sector, container ports and prices are at all-time highs, as well as capacity is at 100%. COVID-related challenges have impacted supply chains since 2020, while the closing of the Suez Canal in 2021 added to this backlog, whilst additional pandemic-related shutdowns of significant ports in China and elsewhere has caused closures, restrictions, and delays. Now, despite all of these issues, consumer demand has been off the charts throughout the pandemic, and pent-up demand from stimulus programs during lockdowns continues to overwhelm the capacity of supply chains. Therefore, the supply chain hasn't been able to keep up with this demand, despite reopening, creating the perfect storm for an increase in costs, as well as businesses to be faced with cash flow issues.
Right, and like for you guys over at Ebury, so many of your clients are involved in international trade. What are they saying and what are you hearing in your client discussions?
Yeah, so what our clients are telling us and what we're hearing is that suppliers are having challenges with products when they're arriving, what the true landed cost is going to be. So this is due to challenges including lack of containers, lack of empty containers, as well as lack of space available on the containers. When businesses are then able to get their shipments onto vessels, they're then running into port congestion issues with the goods arriving late, then causing further delays. There are also shortages all along the chain, from workers in the port to shortages of truck drivers, as well as warehouse workers, which were all challenges that the ports were facing prior to the pandemic, but this has just caused further issues as we entered into the pandemic. So now prices are exorbitantly higher, and there's implications that there isn't really going to be an end in sight. So when quantifying the impacts of these challenges and delays, a good trend to look at is the container price index as well as the container shipment index. So what we're seeing today is looking at the average composite indices. For the world's container index, it's about 238 times higher than the given year average, which is insane. Daire, you were speaking earlier. What are you hearing from your clients in this regard?
Yeah, much of the same kind of noise, really. Like, I can remember a couple of months ago meeting with a distributor in North York area of the GTA, and that business was involved in the distribution of different pharmaceutical goods for over 30 years. And they told me that they rarely spent over 5,000 or 6,000 Canadian dollars for a shipping container over the majority of that period of time. during the pandemic, at one point it hit $28,000. So the multiple that they're seeing on the cost of just shipping containers alone is crazy, and it's pretty eye-watering. I think, if I think about another client example, we helped a really fast-growing e-commerce business access a new debt facility a couple of weeks ago, and the issue that they were really looking to overcome was the inventory conversion cycle in their business had blown out from about 15 or 16 days out to 48 days on average. And that was largely due to the shipping delays. So this business was bringing ceramic homeware goods in from Italy, in from Portugal, and glass in from Japan. And the goods, in many cases, were sitting in ports in Savannah, sitting in ports in Montreal for weeks. And that really affected their ability to get goods into the retail outlets and then convert them into sales. So they were having trouble servicing their debt because their working capital was under such pressure. So we were able to help them find a more flexible debt solution that allowed them to essentially relieve some of that working capital pressure caused by the shipping delays. So what we're really seeing is shipping delays causing working capital pressures across the board. But yeah, I'm interested, Cortney, to hear about what this means going forward for businesses.
Yeah, definitely. So although there has been a little bit of relief in the prices, showing slight declines, the container shipment prices, as mentioned, are almost at 250% higher than a given year's average. So the timing of a normal return to shipping is hard to predict, especially with China moving back into more lockdowns as Beijing has a zero COVID strategy. So this means that when local breakouts occur, the flow of goods could stop completely or they're slowing. And this therefore directly impacts manufacturers that are relying on the ports in China to produce their goods. Another indicator that you can watch is the FRED inventory sales ratio. So this ratio currently is at historic lows. And what this indicates is that the continued challenge for businesses to keep their inventory levels up with the consumer's demand for goods. So what's happening is the supply chains are stretched. So there's shortages of materials, making it difficult for businesses to produce the products. And then the manufacturing sector is seeing very high input costs. And this is filtering down into the services sector as well as labor supply. The PMI surveys have also showed cost increases, which just further shows what the issues are going forward. And there have been efforts to reduce these backlogs, but there's been significant shocks to the system, and these have been compounded as well as unpredictable. So there's really no extra capacity as the supply chain hasn't been able to recover from the Suez Canal closure or the shutdown of the Yantian port in South China. So therefore, the global scale reliability is quite low right now, and we don't really think that it's going to improve anytime soon.
Yeah, it's amazing seeing what this kind of price sensitivity and these pricing issues are doing to business cash flows. And I suppose with that in mind, what have you seen businesses doing in response to some of these challenges? And what does this mean now for businesses?
Yeah, so due to the supply chain disruptions, companies are needing to buy more stock. So they're wanting to have their inventories built up because the delays are taking so long and they're not sure when their goods are going to be arriving. But there's a mismatch between payment terms and businesses' cash conversion cycles due to all of these delays. So many businesses have exhausted their existing credit facilities and they don't have the cash flow to facilitate purchasing this additional stock to build up their inventories. This has also become cumbersome as inflation and demand has caused the prices of goods to increase. So businesses are having a lot of issues with their cash flows and are looking at alternatives to kind of fix this gap.
Yeah. I think from our perspective at Swoop, we've seen a huge increase in businesses taking out additional financing to help cover some of this cost in the short term. And I think, coming out of the pandemic, I think 68% of SMEs in Canada actually had taken on debt during the pandemic, some of which was attributable to some of these issues. For those businesses that have either maxed out their existing credit facilities or are having trouble accessing new debt through their traditional lending channels, What are the alternative solutions that are available to them to mitigate these risks?
Yeah, so a very common product that businesses that we're working with are using is trade financing. And this is a great strategy to mitigate the impact of the shipping crisis for businesses. There's a couple of reasons why this type of financing is sought. And this includes cash flow issues due to unforeseen risks, market volatility, seasonality blocks, as well as backlogs such as the current crisis. And this is causing businesses to run inventories. These challenges therefore cause additional capital needs. So this type of financing is quite beneficial as it allows each business to use capital when it's needed. Essentially what trade finance does is it provides businesses with credit to finance international and domestic payables. How this type of financing works is your supplier would send an invoice. The invoice is then paid by the financing firm, such as Ebury, and then you would sell your goods and services and repay the firm, such as Ebury, within up to 150 days in your domestic currency. So this type of financing is very beneficial as it reduces the liquidity needs for businesses, therefore increasing their payment terms. This type of import lending is unsecured as well, so it sits on top of the credit facilities that businesses already have, therefore not impacting any of the credit that they're currently utilizing. Many of the clients utilize this alongside another form of finance as their extra pool of liquidity that they can dip into. From your perspective, I imagine a lot of businesses are facing similar challenges. What are you seeing businesses are making use of at this time, Daire?
Yeah, I mean, really, we try our best to show businesses optionality and show businesses that even if they've maxed out a line of credit from their traditional lender, there are alternatives and other ways of getting cash into their business. I think trade financing is a really interesting one and something that's definitely underutilized by businesses in Canada. Some of the other products that we've been helping businesses with over the past number of months is, across not just lending, but also government funding programs, such as Can Export, which is a really popular one this year and has different rounds of funding that are released during the year. But again, very relevant for companies that are involved in international trade. Another one worth mentioning is the TRG, so the Trade Recovery Guarantee Financing, which is underwritten by the EDC. And again, this is really to help businesses with working capital pressure. So unsecured funding, part guaranteed by the EDC in Canada. And again, really useful for any business that's involved indirectly or directly in exporting. On the lending side, I think, different forms of supply chain financing, like invoice financing, PO financing, very underutilized and perhaps misunderstood by businesses. But again, very, very useful working capital products to help manage cash flow cycles. I think another one that's worth mentioning is asset-based lending. So particularly where businesses do have fixed assets on their balance sheet, whether that's real estate, whether that's equipment, whether that's inventory, which is unencumbered by other lending products. That can then be converted into working capital. So businesses can use that as security or collateral and then access a short-term lending facility or a medium-term lending facility. I think then finally, another product that we often help with is financing government receivables. So whether you're using programs like Shred, IRAP, or even just waiting on GST rebates from the CRA, all of those can be advanced to you via some lending providers in Canada. And again, help businesses to navigate short-term working capital pressures. So I think, just responding to one or two questions that have come in from attendees. One here that I think we'll just address right away because it's relevant, Cortney, is, so someone's asking here, what if we are already using in our business invoice discounting?
Yeah, so invoice discounting, it is a great way to increase liquidity. However, how we work is we can work alongside factoring companies because we are able to finance the other side of the deal. So because of this flexibility, since there's no collateral and it's easy to sign up, the other trade finance, this could allow you to selectively finance purchases when you need more capital to pay suppliers. So this could be a great addition to invoice discounting. So we can really work together and you can utilize both.
Great. One more question on trade finance from Cortney. So we are already having cash flow issues. This financing is too expensive. So I suppose a statement, but the question to you regardless, you know, how would you respond to that being posed to you by a client?
Yeah, so this is, some clients will kind of pose this when we're talking to them about different financing options. But one of the big benefits of trade finance is because it's unsecured, it sits on top of your existing credit facilities, as well as you're only essentially kind of paying for it when you're using it. So you can have it there. And you only it's on like an as need basis. So it then opens you to have the opportunity for as soon as you need it, perhaps there's a deal that could generate significant revenue for you. You have that opportunity to utilize the trade financing, which allows you to control your costs while having certainty that you have that additional working capital whenever it might be needed.
Yeah, I think that's a good point, particularly at the moment when it's so hard to plan 6, 12, 18 months ahead. One more come in, and you know, it's good to see a bit of interaction here. So is there a minimum amount to be able to utilize these products? So I suppose let's answer that first of all in the context of trade financing, and then maybe I can address some of the other ones.
Yeah, so there's no minimum. So essentially when you're applying for trade financing, there is depending on your qualifications, there would be a maximum, but it's a revolving credit facility, so you can draw down as much as you need and then pay it back essentially on an as needed basis and as you use it.
Cool. And yeah, I suppose just to double back on some of the products that I mentioned, you know, I mentioned some government funding programs, none of which have a minimum amount. So do start at low levels of materiality. Invoice financing, you know, certainly from our perspective, we've helped clients with anything from about 50K up in receivables. PO financing, similar. Asset-based lending, again, it really does depend, tends to be slightly larger facilities, maybe 200 or 300K and up. And government receivables financing, so SHRED, IRAP, GST, again, no minimum amount as such to mention. So unless there's any other questions on those products, I'll just move along. So next point I wanted to chat about, Cortney, what about businesses that are looking to safeguard and protect their margins at this time?
Yeah, so I'm glad you asked that. So despite prices rising, there are actually ways that businesses can improve and protect their margins. So one strategy that they can utilize is through negotiating better rates. And another one is through sending local currencies. So first I'm going to kind of dive into what negotiating better rates is and how you'd be able to kind of achieve this. So negotiating better rates can be achieved if a business becomes a cash buyer. So by utilizing import lending, such as trade finance, you're then able to pay the supplier upfront. This is a strategy that many of our clients are leveraging to improve their supplier relationships and negotiate a discount on their invoice. This can also help with a lot of the supply chain issues as it improves those supplier relationships. Additionally, these better rates or discounted prices can then be used when utilizing a trade financing solution, as the lender will pay the full amount to the supplier on day one. This benefits the supplier as they don't need to wait the full 60 days to receive the funds. This can also be beneficial to a company that is growing. So it allows you, as you get goods in and then turned around and realize the revenue before the supplier balance is in the first place. So this then increases the volume of the trade that you can do. Moving into kind of the second strategy that businesses can utilize to improve and protect their margins would be sending local currencies. So essentially what sending local currencies is it's when you pay the supplier in their local currency. So when utilizing trade finance, you can choose to send send your supplier their local currency while paying back the company financing it, such as Ebury, in your local currency. So essentially how this works is it's beneficial for a couple reasons, as it allows the business to protect themselves from any currency fluctuations, therefore reducing the costs and keeping the margins constant. A good way to describe this is through, I can bring a client example in here. So one of our clients, they were importing stock from China, and the supplier was traditionally invoicing in USD to their clients. But the supplier would increase their prices when USD CNY rate decreased to maintain their profit margin. However, so this would then increase the cost for the business, but the supplier, when the USD CNY rate bounced back, they would not change the prices. So this then increased the costs for the business, while the supplier was then getting just a little bit extra on their side. So by a solution to this would be for the supplier to invoice the business in their local currency. And this is multiple benefits to both the supplier and the business. So the client then can hedge a rate when sending the local currency. So this protects them from any currency fluctuations. So the business can, through forward contracts, they can lock in a rate anywhere up to 5 years in advance. I hope a lot of these goods are getting there before 5 years. But then so this locks in the rate, so it just protects them from any volatility in the market. Therefore, this also benefits the supplier, as the CNY rate did not get adjusted. So the client didn't need to change the prices, and the gross margin then remains fixed. So it then also gives the supplier certainty on their prices and how much they're going to be receiving. So it's really a win-win on both sides. So in this instance, neither sides of the business were then affected by any exchange rate oscillations. So by doing these two strategies, you're able to negotiate better rates as suppliers are receiving the cash up front. Additionally, since the supplier isn't needing to bear any of the fluctuations in the exchange rate, it makes it cheaper on their end. So through this relationship, you can kind of improve your relationship with your supplier while improving your margins and really protecting your business from any exchange rate volatility, kind of providing a little bit of certainty in times when there's really no certainty.
Yeah, thanks, Cortney. Yeah, really, really solid, simple, and good advice for small businesses. Certainly, when we're looking at SMEs here in Canada and also in Australia and Ireland and the UK, so many businesses are using their bank to translate FX and just losing money. So many businesses are not paying their suppliers in local currency, which again is an oversight. And so many businesses are finding it challenging to plan pricing for their customers based on inputs and fluctuations in exchange rates. So just having an awareness and being aware of some of the FX products that are out there is really, really something that could benefit small business owners globally. So thanks for that, Cortney. So I think before we wrap up this afternoon, I just want to open up to questions that people who have joined the webinar might have. So have one that's come in on what size of business do you work with? And Cortney, maybe I'll let you answer that first, and I can then give my piece from Swoop.
Yeah, definitely. So for the joiners who aren't familiar with Ebury, so at Ebury, we specialize in working with small to medium-sized enterprises. So essentially what we do is, in specializing with working with those smaller businesses, we provide tailored solutions and products that traditionally the banks only provide to their largest clients. So since we specialize with working with those small to medium-sized enterprises, we really each person has their own dedicated dealer and point of contact, and we really make sure that the products that we offer suit their business and match their unique challenges that they're facing. We find a lot of our clients, they face seasonality issues, as well as sometimes cash flow issues. So we have a variety of products that would be able to suit their unique needs. For example, if they are a toy supplier, they would be facing a lot of seasonality challenges. So trade financing could be a great product that they would be able to utilize to give them that additional working capital when it's needed. Additionally, forward contracts for importing the products for their specific business could be utilized as well. So we really work directly with those businesses to understand what products that they would benefit them, and then how we can achieve the best kind of results for their business as well. Daire, I'm sure they would love to hear about how you guys work with them as well.
Sure. Yeah. So we don't really have a particular requirement by way of business size. We work with businesses at all stages of their growth cycle, whether they're starting out, pre-revenue, seed stage, or growing and expanding. We try to make sure that we have offerings and products in our marketplace to serve them at every step of their journey. So, even in recent months, we've helped pre-revenue companies access financing through grants and lending products. And we've helped more mature businesses with products like commercial mortgages, equipment loans, asset-based lending. So it really depends. Our whole ethos is to help small businesses at all stages of their life cycle. So thanks for that question. The next one we have here is, a lot of these products seem very interesting for my business. How can I learn more, or who should I reach out to? So Cortney, I'll let you go first.
Yeah, that's a great question. So we kind of spoke about all the products at quite a high level, but I definitely, I invite you to reach out to either Daire or myself following this webinar. I have left my afternoon open, so I'm happy to jump on a call and see what products might be beneficial to your business, to learn a little bit more about some of the challenges you might be facing, to see how we could help. So yeah, essentially, I'm available either today, tomorrow, next week. Just reach out, and I'm happy to connect and see how we might be able to work together.
Great. Yeah, and from our perspective, we'll certainly send a communication to everybody that's registered and everybody that's dialed in, so that you have our contact information. From Swoop's perspective, you can visit swoopfunding.com. There'll be opportunities to book calls, register an account, which is free, and just have a conversation with us, and we'll try our best to identify those funding products that will offer the most value to your business. So another one coming in here. What is the general turnaround time for some of these products? As you can imagine, when I need funding, it would need to be fairly quick. I don't mind answering that first, Cortney, and then maybe I'll hand it over to you. So the Swoop marketplace has hundreds of products in it, so I'll have to be somewhat general in my response time here. But we've helped businesses get funding in less than 12 hours, and we've, in other cases, it's taken a number of weeks, and it really comes down to the complexity of the funding product. So if we're talking about secured lending, where there might be an appraisal required, sometimes that might take that bit longer, a couple of weeks maybe. If we're talking about commercial mortgages, that might take a number of months to close. But if we're talking about short-term working capital financing, assuming the business is come prepared, come debt ready, has the documentation available, has financials ready, bank statements ready, it really can be turned around in a number of days on average. So that's kind of shorter term unsecured lending. And again, for most of our working capital products, which would include supply chain products like invoice finance, like PO finance, all of our lending partners fully recognize that time is very much of the essence, and small businesses need financing very, very quickly. So for those products, the turnaround time does tend to be quite quick. Cortney, maybe I'll hand over to you just to give a little bit of Ebury's perspective.
Yeah, definitely. So for our products, within hours, we could tell you if you would be able to qualify for the financing solution. From there would just be a couple of things that we would need to get from you to just further qualify you. We might ask for some financials as well as some additional information. From there, it would be passed along to our team, and it's a pretty quick process. But essentially within hours, we'd be able to let you know if you would qualify for the products. And then we would do our best to definitely meet your business's needs and get you the financing that you need so you can continue doing great.
Cool. So I think we've answered the questions that have come through. So unless there's any other questions, we'll leave it there and give everybody a few minutes back to their afternoons. And yeah, I just want to say a big thank you to everybody for joining, participating, and giving us their time this afternoon.
I would also like to say thank you everyone for attending. Thank you, Daire, for doing this webinar with me. It was great to chat and talk about some of the challenges as well as strategies that businesses can utilize to improve their cash as well as their margins, and really try and find some certainty and relief in times of uncertainty.
Great. Thanks, Cortney. All right, everyone. Have a lovely day.